Picture yourself thousands of years ago, moving through a thick, ancient forest. You're starving. Every step costs energy. Then you spot it, a shiny red berry glowing on a bush right in front of you. Your brain goes wild. Eat it, now calories, survival. Just seeing it triggers a rush of dopamine. For most of human history, that instinct kept us alive. Immediate food meant another day breathing. But next to that bush, barely noticeable, is a small pouch of seeds. If you take those seeds, clear the land, plant them, water them, and wait several years, you won't get one berry, you'll get an orchard. Endless fruit, permanent security. And yet your brain ignores the seeds. Too slow, too uncertain, too boring. It wants the berry. That tension between instant reward and delayed payoff is the core flaw in the human brain, and in the modern world, it's a financial disaster. We evolved to hunt and gather, not to patiently build systems. We're wired for quick wins, not long-term compounding. That's why day trading a volatile stock feels thrilling, while buying a diversified index fund feels painfully dull. It's why you get excited about a can't-miss tip from a friend, but completely ignore the boring math that shows how steady investing can make you wealthy over decades. Your brain is actively fighting the very behaviors that create real wealth. Smart money feels wrong. It feels unnatural. Saving feels like deprivation. Waiting feels like loss. My name is Bobby, and over the last decade I've studied why intelligent, capable people make terrible financial decisions, not because they're stupid, but because their biology is outdated. If you know what you should be doing, saving consistently, investing long-term, tuning out the noise, but still find yourself chasing hype, panic selling during downturns, or procrastinating on the basics, this is for you. Today, we're going to audit your brain. We'll break down the dopamine trap, loss aversion, and why the most profitable strategy usually feels emotionally miserable. Here's the uncomfortable truth. Smart investing is boring. Painfully boring. It's the financial equivalent of watching grass grow. And your brain hates boredom. Your mind craves novelty, stimulation, excitement. That's why get-rich-quick schemes never disappear. They trigger the same dopamine loop as slot machines. When you see a crypto coin spike overnight or hear about a stock that doubled in a week, your brain instantly imagines the payoff. The freedom, the lifestyle, the validation. That's instant gratification talking. We are biologically programmed to prefer a small reward now over a massive reward later. Psychologists call this hyperbolic discounting. Emotionally, $1,000 today feels more real than $1 million 30 years from now. This is why people consume their seed corn. They can't tolerate the emotional discomfort of waiting, and that impatience wrecks portfolios. You buy an investment, nothing happens, a week passes, 2 weeks, your brain gets bored, so you sell and jump into something that's moving. You rack up taxes, fees, and missed compounding, all because you're searching for excitement where patience is required. Real wealth is built in stillness, in inactivity, in long stretches where nothing seems to be happening. But social media poisons this process. You scroll through feeds filled with screenshots of massive gains, most of them exaggerated or cherry-picked, and suddenly your solid, boring plan feels inadequate. You feel like you're missing out. So you abandon discipline and enter the casino, mistaking stimulation for strategy. Then there's loss aversion, the second major killer. Research shows that losing $100 hurts about twice as much as gaining $100 feels good. Loss triggers panic. When markets drop, your brain screams, "Get out! Stop the pain!" So you sell at the worst possible moment, locking in permanent damage just to feel temporary relief. At the same time, you cling to bad investments. You don't sell losers because selling makes the mistake real. You'd rather hope than admit you were wrong. The result? You hold on to trash and sell winners too early. Fear ends up running your portfolio. And here, where it gets worse, your brain confuses volatility with risk. Price movement feels dangerous. Stillness feels safe. But that's an illusion. Stocks move up and down, but over long periods they grow. Cash barely moves, but inflation guarantees it loses value. The safe option quietly destroys purchasing power, while the scary option is often the only path forward. Your brain optimizes for comfort, not reality. We also associate complexity with intelligence. If something is hard to understand, it must be better, right? That belief is exactly how hyphy financial products get sold. Complexity becomes camouflage. The truth is painfully simple. Spend less than you earn. Invest the difference in diversified, low-cost assets. Wait. No tricks, no secrets. But patience hurts, and complexity flatters the ego. So people chase sophisticated-sounding strategies instead of boring ones that actually work. Add overconfidence to the mix and it gets ugly. We think we can predict markets, time crashes, spot patterns in noise. Professionals with elite education and massive data can't do this consistently, but we still think we can. There's a famous study from Fidelity showing that the best-performing accounts belonged to people who forgot they had accounts or were dead. Their advantage was simple: they didn't interfere. Inactivity was their edge. Financial media thrives on the opposite behavior. Calm, steady growth doesn't sell. Fear and hype do. Headlines are engineered to trigger your amygdala, keeping you anxious, reactive, and trading, because trading generates profit for everyone except you. And intelligence doesn't protect you. Smart people are often worse investors because they're better at justifying bad decisions. So how do you fight this? You automate discipline. You remove choice. Money gets invested the moment you're paid. Before you can think, hesitate, or rationalize, the default becomes the smart action. You also reframe losses. A market dip isn't a disaster, it's a sale. Lower prices mean more future returns per dollar. Losses aren't failure, they're the cost of admission. Finally, you gamify patience. Create milestones, track progress, celebrate consistency, train your brain to get dopamine from accumulation, not speculation. Wealth doesn't require genius. It requires emotional control, the ability to sit still while others panic, to do nothing when your instincts are screaming for action. Your gut saved your ancestors from predators, but it will destroy your portfolio if you listen to it today. Ignore the noise, trust the math. Be the farmer, not the forager. The harvest is coming, even if you can't see it yet.